Welcome to the Explainer. If you're a student of finance trying to picture the absolute epicenter of the future global economy, your mind probably jumps straight to, what, a towering glass skyscraper in New York or London, right? But what if I told you the true frontier of financial architecture isn't happening there at all? Actually, the future of finance doesn't start in a skyscraper. It starts on a dusty counter in a rural village, right inside a low-power micro-ATM. Across these frontier markets, these modest little devices are quietly doing the heavy lifting of financial inclusion. We're talking about places with really patchy networks, serving folks who have literally never set foot inside a traditional bank branch. Now, currently, this little box on a rural counter mostly just moves cash, right? It authenticates an identity with a fingerprint, processes a quick withdrawal, maybe pays a utility bill. But, and this is the kicker, we are on the verge of watching this little edge device step up to move something far more powerful than just local currency. Okay, let's dive into this. In today's Explainer, we're mapping out 5 architectural shifts. 1, the frontier finance bottleneck. 2, the infrastructure triad explained. 3, the shift from payments to ownership. 4, AI coaching at the edge. And finally, 5, unbundling global equity markets. All right, let's kick things off with Section 1, the frontier finance bottleneck, and exactly why traditional banking fails. So why do high-growth enterprises in developing markets consistently fail to get funded? Well, our source material points out a pretty stark contrast. Think about centralized banking. It relies on expensive manual audits, centralized gatekeepers, and highly subjective credit scores. It's clunky. On the flip side, you've got decentralized edge networks. These use localized alternative data to build objective risk profiles. They use secure code and AI automation rather than human gatekeepers to actually verify transactions. The legacy model simply cannot scale down to the village level. It's way too expensive. But the edge model, it's natively built for it. The ultimate roadblock here for traditional banks is what economists call information asymmetry. Basically, it's the massive, practically prohibitive cost of risk validation. Just imagine the sheer expense of flying out a Western auditor to manually verify the point-of-sale histories and inventory turn rates of a mid-sized logistics network in Southeast Asia. It's a logistical nightmare. The data absolutely exists, but the traditional cost of acquiring and trusting that data makes the loan completely impossible. The bank lacks the essential data, so the capital never flows. Moving right along to Section 2. The infrastructure triad explained, and how it's actually solving this bottleneck. So how do we solve this massive bottleneck? Well, according to our frameworks, we're witnessing the convergence of 3 exponential technologies that lock together to form an unbreachable infrastructure. And the best part, it requires absolutely 0 centralized gatekeepers. We've got autonomous artificial intelligence to analyze data natively. We've got distributed ledger technology, or DLT, acting as an unchangeable public record to coordinate it. And finally, edge device ubiquity, literally putting this power directly into the hands of millions. Now, what's really interesting about this slide is how the mainstream press often totally misunderstands this, getting hung up on retail speculation. But as our sources highlight, this triad is fundamentally a massive paradigm shift in data coordination. And this triad enables what we call cryptographic composability. Basically, it means that the standard cheap smartphone in a rural entrepreneur's hand is no longer just a window for scrolling social media or using lifestyle apps. Nope, it actually becomes a highly secure, hardware-isolated vault holding private keys. Because the risk is verified by AI and the ownership is tracked on-chain, these financial assets become almost like programmable financial Lego blocks. They can be easily snapped together, traded, or moved, completely bypassing local banking monopolies. Which brings us to this absolutely intense revelation from the source material. Trust becomes a software property generated by alternative edge data and verified by cryptographic consensus. I really want you to think about what that means for global finance for a second. Trust isn't some expensive commodity manufactured by a legacy institution anymore. No way. It is engineered entirely through software at 0 marginal cost. That is a real game changer. Okay, Section 3, from payments to ownership, and the behavioral leap. Let's step away from the pure architecture for just a moment and look at the human, on-the-ground reality. As financial students, you can actually track this evolution on the ground in 3 distinct steps. Step 1 was establishing cash points, simply moving physical money around. Step 2 was the upgrade to digital payments, reducing friction, improving transparency, and getting users comfortable with screens instead of waiting in long queues. But listen, you can move money around all day without ever actually building wealth. So let's move to step 3 and see how this builds. Step 3, the critical evolution, is turning these devices into capital ports. We are moving from simply reducing friction to actual capital formation. Because the leap from a cash point to a capital port is absolutely massive. Think about it. A cash point handles your basic withdrawals, utility bills, maybe simple remittances. But a capital port, it offers curated, low-risk, tokenized assets, fractional equities, and access to local yield. And the sheer genius of this is that frontier users won't need to go out and download dozens of complex new wealth management apps. They're going to use the exact same highly trusted interface they already use to pay their bills, only now they can seamlessly access global capital markets. It's all in one place. Which naturally leads us into section 4, AI coaching at the edge and behavioral economics in action. You see, transitioning a user from simply paying their bills to actually building true ownership, that isn't just a technical challenge, it is fundamentally a behavioral challenge. To solve this, we need localized intelligence sitting directly beside the financial rails you already use. And surprisingly, we're not talking about some massive AI running in a distant data center. It's actually an embedded agent operating natively right there on the edge device. This perfectly preserves privacy while understanding the user's unique financial rhythm, things like income seasonality or remittance frequency, all without ever needing to ping an external credit bureau. And this brilliantly illustrates behavioral economics in action. The on-device AI doesn't overwhelm the user with confusing financial jargon or scrolling stock tickers. Instead, it coaches them with incredibly simple, context-aware prompts. It might notice a spending pattern and just ask something like, "Hey, you usually withdraw everything. What if we kept just $2 a week in a diversified portfolio? Here is what that looks like over 5 years." It's basically a super smart coach sitting right beside the rails they already know and trust, lowering the psychological barrier to investment to an absolute minimum. All right, on to our final shift, section 5, unbundling global equity markets and the macro resolution. So let's zoom out for a second, away from that local micro-ATM and look at the macroeconomic impact. What actually happens when millions of these new capital ports connect to global, decentralized financial rails? Well, what happens is the massive unbundling of global assets. An everyday user standing at a rural kiosk can suddenly allocate funds into fractional equities, like, say, Apple or Tesla, or even sovereign bonds. But even more remarkably, a portfolio of agricultural loans in South America can now be seamlessly pulled with an infrastructure bond in West Africa. This creates a highly diversified yield product that is accessible to literally anyone on Earth. Our sources argue, with complete certainty, that legacy institutions are completely unequipped for this shift. Think about the old world rails. They survive on paid advertising, artificial market interventions, and their strict monopoly over centralized national databases. But the new world rails, they operate organically. They have zero marginal cost of replication, and they offer 24/7 global liquidity without any human intervention. The analysis is pretty clear here. Legacy architecture simply cannot compete with an organic, decentralized network that scales naturally across every single smartphone on the planet. So the trajectory here is incredibly clear. We are watching the real-time evolution of frontier finance. It is taking everyday people from being a simple user of a basic cash system to an owner of tokenized global assets, and ultimately to a node on these decentralized frontier rails. Anyone touching a micro-ATM or sending money home from a cheap smartphone today, they are already participating in the very edge of this rapidly accelerating global story. The architecture is built, the edge devices are deployed, and this transition from basic payments to true capital ownership is accelerating faster than regulatory consensus can even track. So, as future financial leaders looking at this shifting landscape, the ultimate question is this: are you ready to transition from a simple user to a node on the global frontier rails? Think about that as you head into your next lesson on tokenized equities. Thanks for joining us on this explainer, and we will catch you next time.